Again, welcome to Affinity Insurance Solution. Our focus today is about youth financial planning. Every alternate weeks or twice in a month, we talk to you through this webinar regarding different solutions and different way of thinking regarding financial planning. And our topic today, once more, is about youth's financial planning. As you know, Affinity Insurance Solution works with a strong team members that represents us in the best case possible. We have skills and regular trainings so that our advisors can provide you an expert advice that you can trust and you can follow through on. And you have a strong support from Affinity Insurance Solution that will be by your side when you need them, even after you have the financial planning done with us. So let us start with the topic of the day. Planning for financial independence for youth. The key word about today is young age, youth, those starting their new journey into employment, just graduating out of college or university, and making their way into the life, into the world as a contributing member, as active members of the society who now has the financial responsibility for themselves, and it belongs to the society in whole, so that we can all consistently grow together, improve our lifestyles and each other along the way. So it's important to understand that finance takes a very key role in how your life will look forward. It's important to understand the value of money, understand how these decisions will impact over the long term, how you need to be able to practice these behaviors ongoing so that you can be secured as life moves on, as circumstances changes. So main topic and the key point today is, what should you be concerned about? Or what are the concerns that we hear from a lot of young individuals, young entrepreneurs, as well as from these youth growing out, starting their adulting lifestyle, and are in trouble because they don't know where to get started. But the most important is to ask the right questions. So most common questions that we feel are very important to ask and understand. Some of the things that we will talk about today is, do you have the proper management around the unprecedented circumstances that will arrive in your life along the way? Are you prepared? Have you considered what these uncertainties will look like in your financial journey towards your retirement and towards the lifestyle you wish to have? How are you going to handle these situations? And life happens. We all know this. So we have to look at this very carefully and approach this in a little bit more prepared way. A very good question. And the primary question is, how am I able to manage, and what do I need to manage uncertainties and unprecedented circumstances that could arrive in my life? And there could be many. Some can be managed, some can be planned around, and some are extremely difficult to predict. But there is still a sense of hope, a sense of recovery if you keep yourself in a good plan. Another questions we tend to see from the youth is, I want to build my assets. I want to grow my own property. I want to have a good net worth so that I can be financially independent. And it's a very good point. You need to grow your assets to be able to be financially independent. But what does it mean to be financially independent? Does it just mean that I need money? Think about it. Every effort you have done, all the earnings you have done, you also want to retain them so that You can maximize your lifestyle. You can maximize your needs during retirement. It's not just about grabbing funds and increasing our income so that we have higher assets. It's also about managing expenses, managing lifestyle, and continuing to have a good, healthy lifestyle sustained over the long term. So these are very good questions that we wish to answer today. There are a few more that we have heard. How do I maximize my investment? And I heard this one quite often. The most important part is that once you start thinking about investment, you should have thought about how your budget works. And if that thought process is not there and you just start saving money, maybe it might not end up being the right effect that you wish to have. So look towards a proper advice and a step-by-step guidelines, or plan yourself on a regular basis of what my next couple months, next few years, and 5 years, 10 years, 15 or 30 years, all the way to your retirement would look like. How do you see yourself changing throughout these life stages? If you're single or married, your life still has different opportunities and different situations that will arise. If you're single, you're looking towards your marriage potentially, or you're looking to live your life in a travel world. Whatever it is, you need to think about it and you need to plan it. You need to be able to say, am I going to reach? What do I need to reach those goals? And how am I going to process or run through a process to achieve those goals? And again, one of the key words we hear is retirements. I need money. I need money for retirement, and I want to retire early. That's a dream, isn't it? Everybody wants to maximize their income so that they can retire early. Maybe some would be workaholic, someone like me maybe, who would like to continue working because they enjoy. Some might feel that they want to also have a very balanced work life. There could be those who want to see and do those incredible things and work for charities or see the world and take the time out. Every youth has a different goals, different plans, different thought process, but each of them require one key element. Make sure you plan yourself. So planning is important. And no matter what you do want to consider what your retirement will look like, where and how will it impact, because your decisions now is definitely going to impact your retirement. And if you don't make those decisions now, it will be a much larger impact on you than making those key important concept decisions now, so that it's not a big harsh burden on you. Rather, it's a journey that's comfortable while maintaining a balanced lifestyle, a balanced workplace, and a balance towards that retirement goal. And of course, the last and the most important, and everybody wants to talk about this, is taxation. How do I minimize my taxations? How do I maximize my retention of money and so that I can grow my assets? Well, those are very good key points. And in those thought processes, you will learn what are the key elements that you can use, tools that are leveraging, tools that can give you advantage if used timely, appropriately, and when required. So we'll continue to our topic, solutions. Well, we talked about all the questions that I have heard from the youth. These are key main questions that we have narrowed down. So let's talk about how to resolve them. We talked about planning, but planning requires a sense of understanding. It requires you to think about solutions and expect solutions to work on step-by-step process. So our first and foremost solution requires you taking the time to be on this webinar. It is your education. So take the time to learn what are the key information or the key concepts, key ideas around financial planning. Ask a trusted advisor and always have the opportunity to get second opinion. It is all right to get a second opinion because there you might be able to get a bit of information that you might have missed out, or it might be presented a little differently. So take the time to learn, and that is itself the first process. And value a trusted advisor. A trusted advisor comes through a challenge. It is not just as easy as you would go and expect to meet any professional and accept. You go out and review about that. When you meet an advisor, you want to see if it's a good referral. You want to see that they have done good work in the society so that it will help you as well. So take the time to learn the concepts. Take the time to learn from the concepts from good sources of professionals who are good at their planning. Make sure they are properly licensed. Make sure they have the tools and the resources to maximize your needs, to provide you solutions from varied resources. So it is important to reach out to brokers that can have that set of tools that are available to you. So our next step is also extremely vital and important. Budget yourself. If you don't budget yourself, you don't know where your money is going. So key elements to budget. Identify your expenses. Make sure you measure them. Is my expenses worthwhile there? Am I getting the value out of my expense? Prioritize and control those expenses. If they are frivolous, yes, we want luxury in life. Yes, we want to all have fun, but there should be a sense of budget around it, a sense of limitation according to your potential. Everyone has a different budget. Everyone has a different job. Everyone looks at their lifestyle differently. But you still have to learn to be able to prioritize your expenses, manage and control those expenses so that you can have a better control over it. Excuse me, sorry. So control your budget, control your expenses is extremely important to have this process. Accepting this process is also vital because that is one of the hardest things I have seen youths go through, including myself. We tend to love to spend, but that doesn't mean that it is in our best interest. We have to focus. We have to look at the long-term picture and see the value on the long term of what my expenses are doing to me. Maybe they might be $10 today, but it could be worth a lot more money when you need it. And do you know how you're going to have it? These are the key concepts to value. So start saving. If you can budget yourself, you should budget yourself to save a little. And by little, I mean at least 15 to 20% of your monthly income or yearly income. Start saving. It's not a small amount, but it is an impactful value. If you're not going to save now, you are going to regret it later. Get into the behavior of having that saving. Start taking a small piece of your salary and start saving. It is always something is better than nothing scenario. But if you can manage your expenses, you can prioritize your expenses, and you can have a way to start saving. Once more, if you save, you will understand the value of money. One of the key elements that I want to talk on this particular topic of understanding value of money is this idea that youth has. Our income has gone up. Our minimum wage has gone up. We now make more salary. That's a very good point. But I do wish you to think about this a little bit differently. The person making minimum wage in 2011 might not be making $15 an hour, but their $11.45 minimum wage had a much larger buying power than our $15 in this year in 2022. So even when you look at saying, oh, I have a higher number of income, it's the number that has gone up. But we have to start understanding the value of money, the purchasing power of that money. If you do not understand that concept, it will impact your life. Money is as valuable as it can be used for being able to get the resources we want, products we want, lifestyle we want. But that changes with inflation. That impacts your decision making because the value of money depends on your purchasing power around it. Just because you have $15 in your pocket for the hour you worked in 2022, or the person that worked at a minimum wage in 2011. The person in 2011, if they look at the expenses on the fuel, on the housing cost, on basic resources as bread, butter, and milk, they will have a much better budget because their affordability was better off because their dollar value was strong. Their purchasing power, because of that strong dollar value, kept them afloat. And of course, we are not talking about right now to just be afloat. We want to have money for our retirement, for those unfortunate events. So please consider that money number going up or your salary increasing by a little bit. Is it increase towards inflation or to match inflation? Or is the increase not even worth the inflation and then inflation is higher than my salary increment? If that is also true, and it could be, because we have next 30 years. We can't just look at 5, 10 years. We have to look at the benchmark for the long-term financial plan. And if we look at those situations, then we have to respect that our value of dollar changes. And we must also plan to the value of that dollar, not to the fact that just because my salary has gone up, that it means I have more money in my pocket. Might not, because we are dealing with that high inflation. We are in a youth crisis where affordability of housing has been extremely challenging in Canada. And that challenge is right here in trying to understand the value of my dollar. So please consider these thought processes clearly. If you need more time to understand them, ask a proper advisor and they will help you. But you must understand the value of money before you understand the number of money. It's the purchasing power. Always remember, my dollar has a purchasing power. Third step, an extremely important step as well. Number two is vital. You must start practicing that. Number three is understanding and visualizing that long-term picture. And nobody wants bad things, unfortunate things happening to them. But we all understand the key part. We are reaching maturity. We are now growing adults, and we must accept that life happens. And when life happens, I mean, there are situations in life that could cause you difficulties. Could be having health issues, a sudden change in financials, an expense that you did not consider has suddenly arrived because of you trying to help somebody, or someone in your family needed the funds, or you yourself had an incident that caused you to be in a financial bind. So we must start to respect that we have to consider those things or those events now. We must plan. In health, we all say prevention is better than cure. I believe the same. It should be applied to financial planning. If you can prevent, then it's better than dealing with the cure at a much later age. Hence, start preparing for a situation that could hurt. Your health is the biggest asset. And if you do not respect that, you will have once more trouble in your life, because your health is your wealth. And you've heard this statement from your parents, from your seniors, from your co-workers, or from your friends. You all heard this: health is wealth, health is wealth. But do you truly understand what it stands for? As a youth, we feel healthy more often, we are more aware, we are more active, we respect. And we should respect that our health is great right now. But as you get older, as you age, is this health always going to be on your side? Can you hold on to your age? Unfortunately, not yet. We'll see in the future. But meanwhile, we cannot. So we have to protect that asset. We have to understand that our health is an ongoing battle against age. And we have to protect it. We have to have funds built for that rainy day, for that unfortunate event. If you do not plan it, it will be a very difficult time. Prevent it if you could. And if you have the right tools placed in it, then you can also transit through that unfortunate time a little bit easier. Start creating a source of passive income. And we heard the questions: I want investment income, I want to maximize my assets. Those are great questions, but you must understand that they need to also create an income. Having an investment that does not give you enough return is not advantageous to you. Having an ability to give that investment time to grow and give you those little growths and those passive income over time can really be beneficial. And it will help you towards your retirement as well. Once more, you have to plan for the unfortunate circumstances. You have a liability towards the society. You belong to this society. When you drive your car, you have the liability to keep the other person safe as well. So you once again have to plan for it. Sometimes we feel government mandates it that we need auto insurance, but the fact is it's about being able to protect yourself as well as the society members against that uncircumstantial situation. So we have to protect the liability. The liability is also all the things that you still need to owe to somebody. So we have to understand the concept of liabilities and assets. So let's take a time to take a little understanding around liabilities. Liabilities are all those things that can help you generate income. It can also be considered that based on your income, someone has given you capacity to borrow. That borrowing needs to be paid out. So we have to consider that our creditors, our debts, our loans needs to be paid off. They are liabilities, because if we don't pay, we might be leaving those debts behind for our families to pay, who might be already struggling in their situation. Now they have burden of your liabilities as well. So we want to avoid that. We want to give them the advantage by making sure that we protect our liabilities. You also have liability of paying your mortgage or rent. You need to live somewhere. Month to month, you're paying your mortgage or you're paying your rent. Either or, these are expenses that needs to happen. We have the liability towards our family. If you have young kids, you want to make sure they grow up strong, intelligent, educated, so that they can become good contributing members of the society. And for that, you need to be able to provide them the resources and the opportunities that they deserve. For that, if unfortunate and uncircumstantial events happen or situation arises, do you have the tools that can help you? Do you have the funds that can help them? We have to consider those elements. You have taxes. You have taxes to be paid on a year-to-year basis. These are liabilities. If you owe government money, you have to pay them. You also have to pay probation taxation. Those are key elements that we have to consider even on debt. So our liabilities and taxations tend to remain even after our death, because our families are left with those debts. Or we could be leaving situations that could be hurting somebody else because we might have borrowed something from them. And if we take the responsibility and we want to be those good, honest citizens so that we can contribute back to their needs and so that we can also grow ourselves. Of course, we have expenses to consider. It can happen at any time, but we still need to consider, do you want to be financially independent or do you want somebody else to take care of you even after the death? It's a morbid thought, but we have to consider it. We have to, again, our liability is still towards our own retirement. We have a responsibility for our own lifestyle and our own circumstances for the future. We are responsible for our future. We cannot consider somebody else to be responsible. We have to take that on our hands. So your future, your retirement is part of your financial planning. Cannot avoid it. You cannot push it away. And you cannot always have this statement that I will depend on the government. We live in a great country. We have a great support from our government, but we have to consider that, is it enough for me? Is it enough for my lifestyle, or will I need more? And will the government have the budget to continue supporting me and my family for my retirement in the next 30 years or so? We have to ask these questions. We have to learn to ask these questions, and we have to learn to find answers. We might also want to leave a legacy behind. If you have children or if you work for a charity and you want to leave them something, you want to leave them an asset, you want to leave them funds so that they can also continue doing the work they have been doing, if it's a charity, or your children can get that support and that boost that they need if something happens to you. We have to consider these elements. We talked about this concept quite a bit. Lifestyle, your thought is built around your budget. We all say live within the means, but I would like to say plan your budget so that you can keep improving your lifestyle. Plan your life around your expenses and your budget and your finances so that you know that you have made some strong decisions that will help you when the unfortunate circumstances happen, and then you can take the advantage of a good lifestyle. But you have to plan. You have to consider the right approach. We want to talk about assets as well. Well, we talked about liabilities, all the money I have to owe somebody, all the money I have to give somebody. But what about all the money I made? Fantastic. The money you make is your asset. Everything you afford, everything you will have comes from the biggest source, you, your ability, your health, allowing you to go get income, to get yourself a job, or get yourself a good job so that you have a stable income and a stable resource is your asset. Your education is your asset. The more knowledge you grab, the more you can build around your income. It can help you progress better. It can help you contribute in the society better. It can help your entire planet. So we want to encourage those youth to keep on trying, to keep on updating, keep on getting good skills and knowledge and education that can help you. We want to talk about your primary home. Yes, we all have a dream to buy our own home, to have our home, our house where we can grow our family can have space to grow and make themselves a good individual. We want to give them that resource. We want to live ourselves in a good place. So yes, primary home is your assets as well. Your investments are your assets. If you start saving and start investments, yes, they are your assets. We have considered savings and investments as two assets because investments can tend to have liabilities or risk potential, a sense of loss. But certain savings might be taken away from them sense of loss and kept in a stable environment so that we don't risk them as much. So we are talking about savings separately from investments because investments tend to have a potential of loss, whereas savings are about secured value or funds that you can access in case of emergency without worrying of loss. So we have to balance between having a savings and being able to invest those savings for a better growth. We have to consider our risk and our opportunities and our situations accordingly. But I want you to think about savings a little bit differently and investments a little bit differently because they have two different mindsets. Insurance is also your asset. Insurance can help you pay for those unfortunate events or circumstances if bought correctly, planned correctly, and approached correctly. We have to consider that insurance is an asset. We look at it as an expense and we put it down on the liabilities that I have to pay insurance, but insurance is actually your asset. The money you're putting into insurance is your potential protection against that situation. And how is that situation not an asset? It is your power. It is your ability to stay strong during unfortunate events because you are protected. It's a risk transfer. Therefore, that when you transfer that risk, you are buying an asset to protect yourself against an uncircumstantial event. Unprecedented events happens in life. We don't want to happen, but situations arise. We have to respect that. Mistakes happen. Life happens. Mistakes happens. We are human. But we have to take the opportunity to understand them and plan around them. Your family, of course, is growing. We put family as liability, but the family is also an asset. As your family gets older and growing, they also stand to produce income. Your liabilities reduce, but their strengths are coming out. Their strengths help you become a stronger family. Their strength can help you sustain through those unfortunate events. They are there to become your backbone. So your family can be a liability because you need to protect them. But your families are also your support structure. And we have to appreciate both ends of it. Consumer goods, you might have some collectible items, some jewelry, or products that you have now. They're assets. If situation arises and you need money, you can sell them. We might not get the best value out of it, but they are still assets. So consumer goods, on most cases, are depreciating assets. Jewelry and gold can be depreciating or appreciating, but in general, because of the precious metals and minerals and stones on it, they tend to have an appreciation value. So I want to go back to this idea because both these slides had a message on the side. So I want to talk about this now. So here on the assets, we want to think about assets that are appreciating and depreciating. Appreciating assets mean things that will continue to get better value as the time passes, such as your investment, such as your home will keep having that little bit of growth because the market and inflation will keep pushing the value of the house up. So it's a good appreciating asset. There are or situations or circumstances in life where your house value can have gone down, but overall or the long term, in the segment of time where property prices go up and down, on average we tend to see a good, decent, streamlined growth even on your property. As long as it's maintained, it can have that appreciation. So your savings can be a little bit appreciating, your investments are appreciating, your insurance can have a sense of appreciation or a sense of depreciation, depending what you have chosen to buy, how you have chosen to buy, and how your premiums are going to be impacting those decisions. So insurance can be an appreciating asset or a depreciating, depending on your life circumstances and situation and your current health. But in general, we want to achieve an insurance that is an appreciating insurance. Excuse me, sorry. Inheritance. If you've got inheritance, you have got that family that has backed you up. That's fantastic. Congratulations. It has given you an opportunity that most people might not have. But you have to realize that opportunity came through good planning. And if you continue having good planning, you can give those opportunities to the next generation, to your family, to your charities, maybe to even your friends. These opportunities of inheritance are appreciating if it's managed. And of course, you want to maximize those inheritance you do not try to reduce it. We want to start living a better life because of that inheritance. And yes, you should. But once again, you should also plan that if somebody has given you that opportunity, are you going to pass it on or are you going to leave it at your end? So consider that thought. An inheritance is an opportunity. Inheritance is also a blessing that can also pass on to more generations. So consider. We'll go back to our liability side because there we also want to talk about. Hi there, sorry about that. I apologize. We'll continue to talk once more. Liabilities can be reducing liabilities or decreasing liabilities. As you get older, your potential of income, your income might increase, but your potential of income or producing income goes down. Every year that you don't earn an income, you lose that opportunity. As you get older, time moves on. So you might make a better income at a later age, but you have lost the opportunity of the year. And if you have made that income now, fantastic. We have to consider that once it's made, you cannot go back and make more in the past. So your producing capacity to produce income is a decreasing liability because you have a potential of much higher income over the next 30, 35 or till retirement. But you have to respect that as you get older, your potential of income producing age is also decreasing. Your debt and creditors are based on this idea that you can pay off your debt as you earn. So when you go get a mortgage, the idea is that you have enough earning to make that borrowing so that you pay off your mortgage as you get older. So once again, we consider this thought process that when you are actually planning to pay off your debts and not have them lingering around for you for the rest of your life, you have to consider that you are going to pay them off and start having reduction towards liability and more towards your assets. Mortgage, and again, the key element here is if you have a mortgage and a year after year you or month after year you keep paying those payments, you're reducing your liability towards the creditor and the mortgagee so that you can continue living. Rent is a little bit tricky one because inflation will increase the rent cost, but every year that you have paid for that rent, you cannot get it back. So it is a decreasing liability as you get and live your life in that renter's property, or better off on your own property and paying off the creditor or mortgages. Taxes, again, that's an ongoing basis. It's permanent. It can change and increase. So we have to consider what are my short-term liabilities and what are my permanent liabilities. Your short-term liabilities are liabilities that you can pay off or get rid of that liability within certain time period, be it 10 years, 20 years, 30 years, or so on and so forth. But there is a pin drop or a mark by which you wish to get rid of them. So they are your short-term liabilities. Your permanent liabilities are liabilities that you will have to take care of even on death. These liabilities you have to pay off. You have to consider it could be at any time, or it could be nice and as in a pleasant world where we retire or pass beyond our good health life and have lived the life that we want. Regardless, you have to consider those expenses. You have to consider that these are permanent liabilities. So your funeral expense is a permanent liability. Your taxes is permanent liability. Your retirement is a short-term liability until you start retiring. You cannot avoid pushing that away on retirement and start saving for retirement. So you have to consider the planning of retirement is your liability. That is now, but it has a deadline that you must start saving money and have enough savings in your account so that you can hit that age 65 or 67 and start withdrawing income so that you can retire. Legacy, if you have decided to give a legacy to family, friends, or charity, they are permanent because you want to give them. Lifestyle, as you get older, the lifestyle changes. It can increase, but at one point, you're going to start to balance it out against your budget, against your circumstances, against your occupation situations, whatever it might be. At one point, you're going to hit that mark for yourself so that you can manage the lifestyle and make that consistency after a while. And it's a hard decision. Everybody has big dreams and big things, but we have to accept a small reality. If the lottery comes, good for you. Congratulations once more, sorry. But consider that we have to come down to reality and we have to manage our lifestyle. And then at one point, we have to start maintaining it instead of having an increment. So consider these thoughts carefully, understand what are depreciating assets, what are appreciating assets. Now I'll give you an example. The biggest one and the biggest expense I tend to see these days with the young population is smartphones. Everybody wants the new gadget, the latest gadget, but are we planning for it? Do we understand that this device or this opportunity that we are putting finances against is a depreciating asset? It's not gaining you something more. And if you have enough on your current devices or resources, we want to see, are you going to maximize the new features and new benefits? If you are, great. If you're maximizing your tools, fantastic. Then you're maximizing the use of those resources or those tools, but you have to understand that the device itself is a depreciating asset, and you have to see how that will impact you. Car is a major one as well. We see a sense of this idea that I have a great new car. Fantastic. Do you always want a new car? Okay, let's look at your budget. Let's look at your planning. But you must recognize that your car might be hurting your budget because it's a depreciating asset. It is reducing your value. You might be paying a creditor a large chunk of financial payments on a month-to-month basis, but if you're not getting the use out of that vehicle, you're not maximizing that opportunity, you might be wasting those resources. And we all want to look at that big role model for ourselves. And maybe you want to take a look at the role models like Warren Buffett, who keeps telling you to financial plan. And look at him. His car is a good car, a well-managed lifestyle. But he understands that his car is a depreciating asset. And he needs to focus on assets that will appreciate more than depreciating. There is a point in life, there is a curvature in life that you can start seeing yourself in that position where you no longer want to think about saving. But that cannot be achieved if you don't do what's needed now. And if you start doing that now, you might be hurting that future. So consider to compromise now, because you all young individuals have time on your side. You have the opportunity of time. Last part of the solution to consider is always learn to adapt your budget to the situations that have been changing and to maintain certain things on the course so that you do not hurt the planning and the goal that you want to achieve. So stay the course when you start budgeting, keep on budgeting on a regular basis, and follow up and adapt those budgets as the life and circumstances changes. You should be able to make those adjustments. Learn to subrogate losses. If there was a saving that you had to end up spending due to a situation, make sure that once you recover out of that situation, you start taking a little bit extra effort to recover the loss so that you can be back on the track and the plan you have set for yourself. So learn to recover from the losses as necessary. Make adjustments. We talked about this more often. As you grow older, your age changes, your occupation might change, your employers might change, your employer benefits might change. So keep making those adjustments and keep updating your plan on a regular basis. Once more, maintain the course. At the year's beginning, we all make a resolution. I will go to the gym and I will be in good health. I wish more people would also say same things about financial planning. I will have a resolution to be on a better budget. I will have the resolution to take care of my budget on a regular basis. I will be in a good behavior and start saving. All of these things also should be considered every year. But once more, just like gym, after a few months of spending membership money and signing up contracts, we lose motivation. Please don't, because you lose motivation elsewhere, you will also lose motivation here. Key element to budget planning is you should be motivated for your own best financial interest. And trust me, nobody is more interested in your financial independence than you yourself. And if you don't see that, nobody can value that. So learn to value yourself, learn to value your resources, and learn to take advantage of your resources as you need them. These are the key solutions. How can we help here at Affinity Insurance Solution? We tend to help young individuals make proper financial planning and provide resources and tools that can give them that protection and give them the growth they want. So there are some options that we provide, such as insurance and investments. So I'm going to move this out of the screen for a second and continue talking here. Understanding and leveraging insurance and investments are very important. You have to respect these tools as an opportunity and an assets builder. So how are we going to look at insurance as an asset? We talked a little bit about it. Let's focus on this concept. Insurance gives you the funds you need in case of an unfortunate, uncircumstantial, uneventful situation arises. It can give you a protection. Because you don't have savings or enough savings to take care of those large expenses, insurance can come in and give you that protection and help you out and say, okay, you have been doing a regular premium payments, you have been protecting yourself. Here we have taken that risk because you have protected against that risk. So it can be a very powerful tool. It can be the asset you need in that unfortunate circumstances. You have to then consider, well, if I'm spending on insurance, maybe I'm not able to save, so I'll just focus on insurance. But unfortunately, no, that is not a balanced approach. Because at one point, you have to start becoming more financially independent and stronger and stop deferring your risk to someone else, because there is a cost of insurance involved. But if you have that asset built for yourself, you might not need to depend on that insurance as much, or you might not need the coverage as high. So you can look at your financial planning in a well-balanced approach. One of the key elements I like to say or like to tell my clients, young individuals, is the key concept that two races happening in the society, especially in financial planning. If something happens to you in the short term, the insurance company gives the maximum benefit to the beneficiary or the insured. But if you look at dollar to dollar comparison and you start putting $1 insurance and $1 in investment, and you have a steady growth within a decent equity over the long term, and long term I mean at least 20 years and about 20, 30 years, you will reach a point where your own investment will start outwinning the benefit of insurance. So we want to find this fine-tuned balance where I start saving a little, but I also have insurance so that if something happens immediately, I have that protection, but I also have the ability to become self-insured or self-sustaining or self-independent on financial as I get older, and might not need to pay that high cost of insurance. Rather, I could be sufficient independently. And that's a very good goal to have. It's a very good plan to have. It is a good vision to achieve because you want to maximize your dollar, you want to maximize your value, and you want to have that cash on you so that you can make that expenses on a lifestyle you want. Maybe not now, but more in a better lifestyle on your retirement. We have to consider that. So if you haven't saved or bought too much insurance and not starting to save, you have to find an approach to it. The longer you wait in buying or saving your money, the harder it will become for you and more dependent you will have to be on the insurers. So try to find a win-win situation. Try to find a win and a take situation where possible. So you have to have a balanced approach. Cost of insurance and savings are quite simple. Let's take life insurance example. You can buy term insurance with a large amount of protection at a reasonable or on a lower budget and start maximizing the rest of your budget to savings so that you can have a better retention or maximizing your own assets, minimizing taxation. Take those opportunities. And once again, we'll have a little bit better idea on those concepts because we'll talk a little bit about RRSPs and POS accounts to see how those opportunities can help you. If the government is giving you that benefit, I would say take it. Use the opportunities that are at the table before you start spending a large cost of insurance. And you have to understand this extremely well because there is a competitive world out there. There is a sales approach to the financial planning out there, and you have to be the one careful and have the concern and questions answered before you make bad decisions. And I see this all the time where people are driven by multi-level marketing schemes out there where the approach is not in the best interest of you because you have never approached to ask the right questions. The approach is it maximizing the advisor's income? Is it maximizing the advisor's commission? Then there you have it. Decisions were made or driven from that process. But I want you to avoid that. I need you to think about your own benefit and be calculative about it, be planning about it, be sharp about it. Because someone will take an advantage if you do not know how to maximize or think about your budget. So don't let others take advantage. Be more aware and ask. Get a second opinion. Think about your finances more than just saying that I bought this because a friend told me or a family member told me, or because somebody offered me a dream scenario that might be just a fake dream, might be an illusion that you have not been able to be aware about because you did not take the time to calculate it. So be a little bit aware. I wish really that all youths will take an opportunity to ask the right questions, to learn and approach financial planning more critically, approach this process with strong criticism, with strong scenario of being shrewd about your money, because it is your hard-earned money. You have to learn to protect it against un or ill advices. I've taken a lot of time on that message. I just hope that it reaches the youth so that you can take opportunities that are available to you in the right direction with the right support and the right advice. Age, your health are key elements to proper financial plan around insurance and investment. Time is your biggest benefit. As you are younger, as you are healthier, the cheaper your insurance will be. As you get older, your health changes. Your health can be driven towards a further deterioration. Then your premiums will be impacted by that much. So learn to start having the right vision and approach regarding insurance. The healthier you are, once again, the cheaper your insurance. So see how your health is progressing even after you're managing and adapting around it. We all need to consider these situations because COVID has taught us. Last 2 years has been difficult for everyone, but we know one of the key on-time situation is we have to deal with illnesses that can come from anywhere. So be prepared and be mindful about those situations. Go ahead. So types of insurance you can consider buying. And the most common and the most famous known insurance out there is home and auto. Fantastic. Home and auto is good. It is mandated within Ontario or within Canada. But do you understand why you are buying it? You're buying it because you take on a liability when you go down the street, when you drive your car, you have a potential of somebody hurting your assets, which is you, or there is an error that can be happened by us that we might damage somebody else's property or their health. And we need to be able to provide them the support as much as you wish to have that support for yourself. As you can learn, health changes can be sudden and unexpected, and you must continue your life, right? The show must go on. So you must be planning around it. So liability insurance is key factor in understanding that I can take away those liabilities by transferring my certain risk and my protecting my assets such as house or my high value assets at home or even bike or jewelry or your other products. They are ways to protect your assets. So that's awesome. We now have a general idea of general insurance, known normally as property and casualty insurance, where you're protecting yourself against those perils, those covered perils such as fire, storm, wind, accidents, wherever the circumstances be arriving from. We are taking the insurance to protect that situation. So Benefits are simple. You're protecting yourself, your family, your friends. You're protecting that precious properties that you have been paying those mortgages for or those loans for. You are protecting that high value assets because they are important to you, including your family is important to you, your health is important to you, the friends that drive in that car is important to you, the people in the society that you interact with are also important. So we want to make sure that we protect that situation. So that's the first step of insurance. The other types of insurance that we tend to see are life insurance. Life insurance is the key, most common element that we hear from our parents. It's a good plan, but I want you as a young people to consider this important, but I have a much more important protection plan and element for you to think about. Meanwhile, we'll talk about term insurance because that can happen at any time. That can cause consequences towards our family, towards our friends, or towards our creditors. So we want to make sure that we have protected these situations, these liabilities that we are standing on. So you can buy life insurance. Life insurance tend to have two standard concepts. Term life insurance. Term life insurance, quite simple and straightforward. The protection, the benefit amounts remains the same for the term of the policy. So does the premium remains the same for that term of the policy. And term insurance usually tends to have lower cost of insurance, so the premiums are low. The benefit is that you get to lock in your health now so that you can protect that short-term liabilities for that time period. And once they're done, we might not need that insurance anymore. And remember, your biggest asset you own is right now. It's your ability to earn money. And it is going to decrease as you get older. Your income might go up, but your ability to earn money is going to go away as you get older, as the years pass by. So you want to maximize that protection now, not actually have higher insurance later, but you need higher insurance now. Consider that more carefully. Term insurance has, can you go back there, please? Term insurance can have a significant advantages. If it's independently bought and not bought through your group plans or through mortgage or banks under the mortgage life insurance plans, you have the ability to be flexible because you can cover a variety of creditors. You might not be limited to one creditor or two creditors, or as your creditors change from one bank to another, you can keep one policy consistently there and can transfer across all different risks and still provide that. The beneficiary also has a bit more control on that term life benefit on an individual basis, because the beneficiary can decide what to do with that money before, if they want to pay off the creditors, if they want to keep making those smaller payments to the creditors, depends on their situation that you have left them with. Because you could be paying a mortgage. Maybe they don't need to pay off the full mortgage because the mortgage will continue and they can make smaller lump sum payments, while your that benefit can be building up assets so that your family can have access to those cash in that unfortunate circumstances. Because it'd be very hard to pay off a loan and then for that surviving spouse to borrow a significant portion of that fund anymore, because it will be subjected to their age, their health, their income potential. Whereas if you provide them resources, then they can maximize that ability or leverage that ability so that they get to decide what to do with those funds, and could be beneficial. And once again, with term insurance, your affordability can provide you much higher coverage than buying something like a permanent policy. Permanent policies are fantastic for estate planning. They tend to be a tool in a balance between estate transfer for estate maximizing versus just buying coverage for liability, where we have to take the scenarios and plan it so that we can look at our stages of life and see how we can recover after out of short-term liabilities and take care of permanent liabilities with permanent insurance, where we might not be looking towards a larger benefit or a larger paycheck as much as the current liabilities might need be. Because remember, if your liabilities are paid off, your mortgage is paid off, those assets are still going towards your beneficiary. You have good funds in your TFS accounts, they are still going to your beneficiary. They are being given out or transferred. So you are still giving them a good asset. It doesn't have to be insurance. It can be other sources. So plan those situations according to your needs, your lifestyle, your circumstances, and your budget. Don't just get into something that someone else did and you must do it as well. Maybe it's not in your best benefit. A plan we provide for a business owners are quite different than a plan we provide an employee, because their income tax situations are different, the financial planning requirements are different, the liabilities also look different. Make sure you understand the cost of insurance versus the premium payments, because in a permanent policy, your premiums is divided between cost of insurance and investments. And if you don't know what's doing what, it might not be your best opportunity, or it might end up hurting you over the long term, where the policy might lapse, or it doesn't have the funds you need to retire, or you are missing funds that you might need to during that unfortunate circumstances, because permanent policies tend to have that higher premium because they are permanent risk. The insurer knows that they have to pay out this benefit. So you have to consider these situations before you start just making purchases. There is a time, a place, and an opportunity for both term insurance as well as permanent insurance. But you have to look at your budget, your planning, your own situations and circumstances, and see which one is being leveraged towards your best interest. So don't just get into a policy without getting a proper understanding about its impact. The main part that we want to talk about is not just about death in financial planning. We want to talk about what happens if something really bad happens to our health, but we are still alive. We want to talk about those situations where we want to fight against cancers or those illnesses and survive and live our rest of our life. But at that time, we need funds, we need opportunities of resources, and they come with more money in your pocket. If that's the situation, you have to consider critical illness insurance. You have to plan how living benefits can help you. Living benefits includes things like critical illness insurance, disability insurance, drug and dental plan. All of these can help you while you're still alive and facing that circumstantial situation. It could be to you, it could be to your spouse, it could be to one of your family member. Neither or either it happens to anyone, it will impact you, it will impact your financial planning, it will impact your lifestyle, it will impact that retirement goals, it will impact the next goals you have set for yourself if you do not have proper planning around living benefits as well. Critical illness also tend to be available in term manner or in permanent method. Once again, critical illness bought on a term can give you a much larger protection for a shorter term, save you a bit of a premium compared to a permanent policy. Once again, according to your requirement, your financial planning, your lifestyle, your occupation, it depends on where you are and what your situation looks like. So financial planning is extremely personal and depends on each individual separately. Hence, take the time, approach an expert that can make the maximum benefit in your interest. We also have key element. And remember, I told you a while ago, there's one thing I want to focus the most on: disability insurance. You must recognize this as the key foundation to your financial plan. And why do I say that? Because your entire financial planning depends on your ability to go get an earning. Your financial planning depends on your income coming month to month. Your goals are all dependent on your income. And if you cannot protect that, you will have situations that will hurt everything. It will hurt your goals, it will hurt your retirement savings, it will hurt your life insurance. It might even hurt your critical illness, whatever the situation may be. You need to protect your health against that income replacement. Can we go back, please? Disability is usually known as income replacement plan, whereas critical illness is known as recovery benefit plan. And we'll go back again to the critical illness. Sorry, it went a little bit further, faster, but we'll go back to critical illness there. Critical illness is known as a recovery benefit. Recovery benefit because you have to survive that critical illness and move towards recovery. It is going to help you for those expenses that you need for those critical illnesses that occur. Whereas disability, and if we'll go back to disability, is about protecting your income. When you have a situation of disability, you are already having a hard time making an income. So protect that income, but protecting just the income might be not enough, because while you're recovering, you might have additional expenses, especially when those illnesses are very harsher or critical illnesses. That's where the critical illness comes into play, where it can help you pay a lump sum benefit so that you can maintain your expenses, maintain your budget with disability insurance, and take the benefit from a critical illness policy and pay off those additional expenses to manage your lifestyle around your critical health issues. But the foundation, the most important part of financial planning is how are you going to protect your income, because everything is based on that. So please ask your advisors, ask the right questions from your employer benefit group plans, and ask to yourself, have you taken the opportunity to protect your income? Because if the event happens, you might no longer qualify to get that coverage. It might be too late. Age is on your side, timing is in your side, your health might be on your side. So take the advantage of it and get that protection, lock in that help now with an insurer. Don't delay it, because it might impact your budgeting differently at a later age. We'll move on to investments. If you're protected their income, and I hope you all have understood or got my message to go out and get yourself a proper insurance against income protection, and you've taken the advantage of it. Now let's talk about investments. Of course, you want to start investments. You want to minimize cost of insurance so that you have more dependency on your own money instead of having somebody else come and take care of you. Because we don't have earlier savings, we will depend on insurers. But if we start having our growth and our savings year after year, month after month, and have that assets grow, we can be well off. How do we do that? By maximizing the leverages the government provides. The government provided leverages are usually referred to as registered investments. And registered investments are some of the key words that you might have heard: are registered retirement savings plan, or a spousal registered retirement saving plan, a TFS account, tax-free savings account. So let's talk about these two quickly. An RRSP is a tax-deferred plan. If you're producing good income right now and you can budget yourself to start saving, then if you put something in RRSPs, it can be deducted against your income tax for that year. That means you have a potential of getting a better income tax return, and you end up paying a little less tax. And if you get that tax return back, that is a benefit. And when you put that tax return into TFS account, on the other hand, is an account where you deposit money that are net of your earnings. So then you can leverage a TFS account. You take a little bit of advantage of RRSP, get that tax deferred on your savings, have that compounded growth on the savings, so that you can consistently grow your funds inside RRSP and defer the withdrawals until retirement, so that when you're withdrawing those funds on retirement on a smaller chunks, because you might not have large liabilities to pay off and you might just be needing funds to retain your lifestyle, you would be at a lower tax bracket and a lower income. And that's the goal behind an RRSP. Of course, you're limited based on your income potential or your income year after year. You are maximizing according to the government limits. And we can talk more details, or we do normally talk more details on these accounts on our other webinars, on specialized webinars, just on RRSPs or TFS accounts. Of your deposits are there within an RRSP based on your income, based on what you can or cannot take advantage of RRSPs. TFS accounts, of course, has a yearly limit, has conditions around it, but usually the advantage of a TFS account is that your growth is tax-free, and on withdrawal you don't need to pay taxes, and the growth is also capital gains free. It is a huge advantage. If you would like to know and understand a little bit better about capital gains, please approach us, but I'll generalize this. Capital gains is a taxation that you have to pay on a growth, on a passive investment other than your home or TFS account, where you will end up having to pay a capital gain on that or the sale of an asset. And there's a taxation rule around it that you end up paying a larger piece of the pie in taxation. So learn to take those advantages as your lifestyle and plan changes. In the other accounts, once more, and registered, the RESP account, if you have a young child, you can take advantage of RESP accounts where the government is providing grants, its government is providing advantages where they will help you grow those assets tax deferred for your kids, where you can choose to invest the money and choose where to invest that money for a better growth and transfer. This is absolutely new concept and a new idea in the market based on the current budget. The budget is hopefully going to pass, but the budget shows that there is an opportunity for young new youths to take advantage of this upcoming new account starting in 2023. The exact information and dates are still pending, but we have a general idea of what these accounts can do, and it can help you save money towards your first time home. It gives you advantages that are not in an RRSP and not in TFS account. Rather, it's giving you a piece of benefit from both. It gives you an opportunity to save your money for your a tax-free first-time home savings account has certain advantages that have been informed or been presented in the budget. They tend to inform us that you can get deductions on the deposits on your income, and you can withdraw these funds with growth without paying taxes. So essentially, it's a tax-free savings account simulation so that you can withdraw these funds for your first time home buyer situation. And it can help you start saving towards your home, building your own assets. It's a good opportunities coming up in 2023. Another concept that you have is you don't have to just save inside a registered account. Registered accounts tend to have advantages that the government can provide. A non-registered does not have any limitations or advantages, but it still can be good opportunity for growth. You can start saving money here, start building assets, and build your portfolios so that you have that funds when you need it, so that you can use these funds on retirement. But non-registered accounts tend to have taxation on a year-to-year basis, based on actual cost basis calculations. And again, we can talk more about these concepts at our specialized webinars on each of these topics. We tend to have a bi-weekly webinar every month. So at least every month, twice a month, we tend to have a conversation with you through these webinars and help you get key concepts and key understanding regarding financial planning, regarding insurance, so that you are always informed and up to date on these skills, so that you can make an educated decision and maximize your dollar, maximize your leverage. So non-registered accounts tend to be quite simple. They tend to be subject to income tax year after year, and they tend to have growth options that you can choose. And there's no limitations of how much or what you can put into it, like the rules around RRSP, TFS accounts, RESP, and those accounts. So leverage them accordingly. If you're a new immigrant or if you're a student who is still starting, there are some key elements that you might be interested in start saving. You might be running a part-time job and paying for school, or you budget yourself accordingly. Plan it, maybe start saving a little bit. Maybe put it in a non-registered account, because your income might not be as high that even these growths might not impact your tax bracket, so that you can still take advantages of this account. But learn to use these appropriately and see how and when it is in your best advantage to use these accounts, and are they giving you the best growth that you need. So what can you put inside registered or non-registered investment accounts? You can buy GICs. GICs are guaranteed income funds that you can, if you are not driven by risk to gain more potential income, but you are conservative and you want to protect your money, your savings, and we talked about having small piece of that savings in a way that it does not have the risk of loss, then GICs could be your option. Excuse me. You can buy bonds within these portfolio or accounts as well. You can buy portfolios of segregated funds. You can buy portfolios of mutual funds. You can buy ETFs now, or you can buy stocks. All these options exist so that you can make choices according to your requirement and your need and your risk tolerance. Again, looking at your financial planning, your budget, and your lifestyles and situations around it. So look at these situations, look at your timeline regarding planning, and use them accordingly. We at Affinity Insurance Solution do provide you access to GICs, bonds, segregated funds, and we will soon be offering mutual funds as well. But meanwhile, we can provide you GICs, bonds, and segregated fund options and portfolios. We do have ETF portfolios within the segregated funds available now as well. So come, learn, and ask the questions of what you can do. There tends to be a small confusion. Can we go back, please? There tends to be a small confusion in the general market where people think GICs are accounts or segregated funds are accounts or mutual funds are accounts. They're not accounts. They're tools of investment. The account like RRSP or TFSA accounts or non-registered accounts, they are accounts. Inside those accounts, you can choose how you want to invest that funds. So these are the tools of investment. The method by which you can choose to invest, because they have, all of them have different leveraging benefits. So learn to see which one is benefiting you and when and how. Segregated funds can be excellent for that long-term financial planning because it can provide you guarantees on maturity, it can provide you resets on growth, it can provide you maturity or I apologize, guarantees on debt. Whereas mutual funds can be a little bit cheaper on cost wise, on an MAR cost, but might not have the securities and the leveraging benefits of seg funds. Know those differences. Once again, come to our other webinars and you will learn these differences and then make a choice. But make an educated choice. Don't just choose because someone has asked or told. Rather, you have to ask the right question. You have to do the research and take second opinions. The key element of the conversation today, the most important part that I want to talk to you about today is you are young. You have the value of time on your side. And that time can help your savings and maximize your growth. And you'll be thinking, it might not be that simple, but it is that simple. It is that simple to understand that if you start saving little now, it can be impactful a lot more on the long term. Let's look at that scenario or situation. What are the key elements to any investment? Be it your house, be it your business, be it the registered account or non-registered account, be it the tools you have chosen to invest with. You still need two biggest elements with any investments: time and money. If you have too much money and you don't give it enough time, you might not see the growth you need. So if you start at a later age, hoping that you will start saving at a much later age and everything will be hunky-dory, it might not be in your best advantage. If you have too much time and you don't put enough regularly, you might also still end up not having a win. Might not be maximizing your budget, might not be maximizing the advantage of investment. You are just starting. So yes, something is better than nothing, but you have to consider to find a balance. And balanced approach is enough funds, enough time gives you the maximum potential of a stable growth, a growth that you can count on, and a growth that you can be proud of. But you will need to start on a regular behavior now. learn to respect the value of your money now, then the time will give you the benefit of respecting your money in the future. Give you the advantage to live the lifestyle you wish to have or maintain. So consider this. For a young person, I truly want a young person to understand one key element. We talked about how numbers doesn't mean the value of money is up. It just means the purchasing power of your money is important. We have to look at inflation. We have to look at deflation. But there is one more key element. You have to start looking at your money now a little different. The spending you're doing today, let's say you're spending $100 on a phone or a monthly phone plan, that you might not be maximizing or taking a full advantage of the resource at your hand, but it makes you feel good that you have the latest and greatest gadgets now. But do you know the impact of that dollar or that expense in your future? Because if you plan and think about it, and you end up saving that $100 that of unnecessary expenses on a luxury item that can be compromised now, that $100 saving can easily be worth more than $500 over the next 20 years. And if you think about that, and if you save 100, you can be looking at assets of large amount of your own money, of your own leveraging power. If you grow them in good investments with good equity returns on average of 9%, then you can have a significant growth. And the potential for you to take risk now, because timing on your side, you can get better returns than just 9%. And you can average a much better result because you can give the opportunity of time. You have that ability now. But if you do that in the retirement, it might not help you. It might not be enough. And it might run out before your life ends and your retirement continues. So plan your spending, knowing the fact that every dollar you spend now is worth more than $5. You buy a $1,000 phone today, it's worth more than $900 in your life. Think about it. Approach your expenses very diligently, because if you don't give your money time to work in your best interest and you spend it away, it's not going to come and help you. Balance between insurance and investment is very important in your financial plan. It's very important to be more calculative. And yes, we understand that everybody has a different skills and different abilities. This is why different members of the society contribute differently. You reach an expert when you are physically sick. You reach an expert when you are financially sick. You reach an expert to give you the advantage of maintaining your good health. Then you should also reach out to an advisor that can help you maintain good financial health. You reach for a good mechanic for your own car. What about your biggest asset is you, your own value, your own health that allows you to go get an earning? Have you approached the best mechanic? Have you approached the best advisor? If you don't take advantage of these things now, it will hurt you. We want the best things for our depreciating assets, but we ourselves are losing the advantage of putting that funds towards our own advantages or our own protection or our own growth. So think about your financially or financial planning differently going forward, and approach your financial planning now immediately so that you know your course, you know your planning, and ask the advisors or experts so they can help you on that journey. We talked about this. Plan now. Your health is your wealth, your time is your wealth. Learn to leverage both. Learn to maximize both. Start respecting your own financial planning, more important than certain small luxuries that you can give up now so that you have a stronger, better financial plan for your future. And so that you can proudly say that I am financially independent and I have planned myself, that I don't have to depend on others' mercy, that I have taken the good grant of mindfulness so that I became financially independent. And trust me, that confidence, that proudness that you will feel for yourself will be more happy feeling than some depreciating asset that you might have spent on now. That confidence will drive you even further than sitting on a dwindled account on this popular idea that seems to be a fun way to say things is I'm broke. Please, how can you be broke so early? It is your opportunity, not your end. This is your start. So start leveraging this opportunity, become financially strong youth, and lead others to make strong financial decisions. It is very important that we make a stronger financial society. I want to reiterate the main key points of today is your financial planning depends on the key element is your income. So go get your income protected. Make sure that your biggest asset is protected. Instead of spending those unnecessary expenses on appreciating assets, start protecting your biggest asset. It is you, your health, your ability to earn money. And that is the foundation of everything that you plan to do with your finances. Hence, disability insurance is a critical part of your thinking process. And once you have that income protected, you can start building your assets. You can start protecting your assets. You can start to leverage your dollar, your hard-earned cash. Hard-working individuals needs to have the opportunity to make the best out of their budget. And it will not come if you don't take time and the effort and make educated decision. So please reach out to a trusted advisor. Please reach out to those that can help you on your maximum benefit. And it's not about just their income, rather it's about protecting your dollar. Understand these things. What are the key elements that makes people fail? Yes, you see it. You have seen it in your lifetime. You see it in friends, families, or in the society. People have failed to manage financial planning. And people have judged them and called them out. But do you know why certain unfortunate situations that lead to a failed financial planning? Here are the key concepts. They fail to start on time. It is the time for you. So no longer you have an excuse to fail to start. You have an opportunity to go forward and start now. They tend to miscalculate their priorities. Of course, if you don't budget yourself, if you don't manage your expenses, you don't prioritize your needs, then you will have a failure on priorities. Lack of knowledge, lack of awareness. We can help you a little bit on that. But it is you who has to take the first step to reach out to us so that we can help you. We are with our expertise and knowledge so that you can maximize your advantages. Of course, there is a sense of denial to the idea of value and expert advice because everybody now feels that they can just Google things up. Love the fact that you can Google things up. But sometimes, do you have the skills, the knowledge, the acumen required to understand the information presented? If not, you have to respect an expert. You have to also understand that you need to maximize your expertise and put your time in your expertise so that you can maximize your growth. Instead of considering this idea of saving money against self planning so that you don't approach a financial planner, might be losing you thousands of hundreds of thousands of dollars. And your time spent for your family, spent for your own increment in earnings can be far more valuable than trying to compete on an advisor's income or an advisor's commission. It's a good thought process. We should all save. This idea of saving must exist. But if used inappropriately, we lead to making major mistakes that will hurt us on a lifetime. You approach an expert with the sense that they are providing a value, and that value is beyond the savings you might end up doing if you were not the expert and you tried to just find random information. So take the time to sit down with a good, trusted advisor. Of course, lack of motivation and procrastination is a key element of our culture. Don't let that be. Be motivated for your own well-being, physically and financially. And don't procrastinate because it will hurt you. Again, lack of accountability. When you can't truly account for your mistakes or your decisions or your planning or your decisions, you will fail and maintaining the accountability of maintaining a good plan. If you don't review it regularly, you will forget about it. If you don't make those regular deposits and savings, or you don't plan for a proper insurance, you won't be able to be accountable or have the proper benefit that you deserve and need on during that unfortunate time. So you also need to make sure your insurer is good, your products that you have considered for your solutions have the coverage you need for that circumstances. And that is a thinking process, an elimination process, an understanding process. One of the other key elements is people tend to give up because they cannot recover from a setback. Yes, setbacks will happen. Situations will go haywire. But you don't let that control your future. Rather, it is time that you let your setback be setbacks in the past and start looking at the future once again so that you can recover, but always consistently move and be motivated towards that future goal in mind, please. And of course, key and the last one is some people just don't want to do it. I understand. Maybe their priorities are completely different. Maybe the thought or their understanding regarding finances are different, or their approach to life is different. And we respect that. Everybody must have their own thought. But if your thought is towards proper financial planning, your thought is towards being motivated to understand value of your dollar, understand to protect your assets, your growth, your health, your income, your family, your friends, your assets, then plan now and don't let it just be a pass. We will open our mics to questions. We have covered key concepts regarding the principles of why you should financial plan, and we are talking about various solutions that you can consider. Have questions after the webinar, of course, email us or contact us and approach us through our sources. You can watch our in-depth webinars on different solutions and ask questions then, or you can email us or call us and we'll be happy to help. And if any of our expert advisors will help you. Okay. Thank you guys for the feedback, and we look forward to hearing from you guys and looking forward to serving other or seeing you at other webinars for in-depth understanding of finances. Thank you and have a wonderful evening. Take care, guys.